Well, hello everyone and welcome to the Horowitz & Company pop-up Q&A webinar for July 13th, 2020. Thanks for joining in. Hopefully everybody is staying cool and healthy because the heat is on. I mean, we're talking about heat outside that's out of control, and this whole pandemic, what's going on with regard to the number of cases and increase in hospitalization, especially here where I am in South Florida, which seems to be the epicenter now of all this madness. And we're seeing records broken seemingly every day over the last number of days, not only with the heat index that we're seeing all over the country, but also with the virus. So it's kind of a very troubling time. You know, the hope was, if you remember back when this all began and we started to see the numbers pop up in February, March, and April, the whole idea about, hey, you know what? This is all going to peter out when the weather gets a little bit warmer, because the flu and viruses, well, they don't like the heat. And here we are in the dead of summer, and the virus is raging on. The numbers are off the charts. So we're seeing records there, breaking numbers with Texas and California and Florida and many other areas around the country. And we're seeing a lot of things all of a sudden change. This afternoon, we saw that Gavin Newsom from California said they're closing all indoor activities, inclusive of things where you can gather. Protests are banned, and going to zoos are closed, and restaurants, movie theaters, they're closing them all down again. And we're seeing that in Miami, restaurants are closed again, and possibility of schools not reopening, which is what schools are supposed to open right around the corner from here, right? Next couple of weeks in Florida and some states. So it looks like there's going to be a question as to how that's all going to work out. San Diego County, LA County, in that area also said that only going to open up for online education, no in school. So there's a lot of argument going back and forth with the administration on that, but yet we know the states have the final say in all this. But not only are we breaking records in terms of heat, in terms of new cases and the increase in hospitalizations, but the stock market is also breaking records. With that in mind, we did see a significant turnaround today. The S&P did get to the break-even zero line again for 2020 and fell off and turned around pretty quickly as the news developed throughout the day about California closing and about all the other areas around the country that are going to postpone school openings, et cetera. So there's a lot of anxiety that's going on. That's probably at a record also. So we're seeing a lot of things that are converging all at the same time right now. I'll mention to you, by the way, if you have a question and you want to ask, you could do so over in the Q&A panel, so make sure to do that. Before we go on any further, I'll mention that this is not a recommendation to buy or sell any security. This is just a discussion for educational purposes only. I will try to answer any and all questions that you pose. Some of them I may not know the answers to, but you have the opportunity now to ask anything that you want. Just let it roll. That's what we're here for. That's what we started this for back in what it was, March, April, and I said, and I'll tell you again, hey, as long as we have a good crowd and his interest, we'll keep doing this. So right now, there's a lot of interest. And I'm pretty surprised, actually. I want to thank you, everybody, for joining us in this, and hopefully this is doing a lot and helping you a lot in all of the various questions you have regarding the markets and the economy and the finances and what's happening with your portfolio, giving you some insight, because I honestly, I did not expect us to be sitting here on July 13th. Just like I probably don't expect us to be here in September, but who knows? Maybe it's destined to be. But just as a point, and getting back to this is a general conversation. It is not to be used for any specific advice nor a recommendation, and you have to seek professional financial advice when it comes to your portfolio. So I'm going to talk about a few things here. Like I said, load up the questions now. Anything you want to ask, there is no limitation on the complexity or the simplicity of your questions. Just ask away. Don't feel embarrassed, this is your time. This is where you get the opportunity to do so. This week, let's talk about what's going on this week. So this week, we have, aside from all the things we just talked about with regard to the pandemic and the news flow that's happening, and probably more going to be out there throughout the week, we have a pretty important situation happening. That is the start of earnings season. Now, we know that for the most part, everybody said, hey, you know what? Earnings season and earnings for the first quarter, nobody cares. We know it's going to be kind of weird because we had the shutdowns and we had partial periods and we had questions, and companies were pulling their earnings results and their guidance, or the guidance at least. But what about the second quarter? Second quarter is going to be bad. Let's clearly state that fact. That was the quarter that encompassed most of the shutdowns, all of the slowdowns, all of the people that are pretty much hiding out, even if they weren't under quarantine, and all those people that were under quarantine. So this was a period that was very, I would say, concerning. And a lot of the things that have been discussed by analysts are also in the same vein as we saw last quarter, that, hey, this is a throwaway quarter. Let's not pay attention to what's happening this quarter because we know it's going to be bad. I don't know if we can necessarily do that. I don't think it's appropriate to do that. I think we're going to find that many companies will continue to distance themselves from the idea of providing guidance outward. Pepsi was out today, and as you'd expect, they said, you know what, they're not going to be providing guidance for the year. They said, hey, you know what? Our drink business was down pretty significantly due to the restaurants and all the people that would be buying that for consumptions. But our snack business, particularly our salty snack business, was up. I can tell you, I am part of their salty snack business because one of the things we did was stock up at the office on chips. Since we weren't really going out and all that, we figured, you know what, we might as well have some chips and some snacks around the office, much more than we had ever before, getting us through the day-to-day grind of staying in the office and not really taking a break and ordering in or bringing in food from home. So what we have right now is a situation where Pepsi did beat, and they came in a bit better than expectations by about, I think, 10 cents. Did a little bit better than expectations on revenue. But the one thing that I want to explain to you is this. While they did beat expectations, stock was up 2.5% or so today, early on. I didn't see it at the close. But one of the things you saw was that they are down. Their earnings are down from a year ago, July. So when we usually compare a year ago to where we are today and see how the stock has progressed and how the company has done, their earnings are down. Now, meanwhile, their stock is also at the same level it was a year ago. So really, they didn't see that expansion of multiples that a lot of other companies had. But the good news is, I got to tell you, if they're down a little bit from last year at this point to where we are today, considering all the things that are happening, not such a bad situation, and probably why the stock was rewarded today in the market. Now, let me just get back to the markets for 1 second. We did see a massive turnaround today. In particular, we saw the NASDAQ hitting an all-time high once again today, and then sometime during the mid-morning, we saw some weakness start to creep into the markets. The Dow was pretty strong, up about 500 points today. And Dow finished flat for the day. All that move on the upside came down. NASDAQ down about 2% on the day, which is pretty telling. You saw the high flyer names. I mean, Tesla was roaring up today 15% or something like that at the high, finished flat on the day. And we saw other names like your Zoom Medias and your Pelotons, all the massive moves that we've seen from these companies, particularly in the NASDAQ. The high flyers like Fastly, these things turned around. Netflix down 5% today, turned around dramatically today after hitting those all-time highs. It was kind of an exhaustion move. One of the indicators that we have is called the key reversal indicator. And if you remember back a few weeks back or a month ago, maybe it was a month and a half ago, we saw that it hit an all-time high. In other words, overheated the most I've ever seen it in history, a +7. We got a +4 reading today, which is not as hot as a +7, but we saw a culmination of many days in a row with the same kind of situation happening. And what that did was kind of telling us that there's a lot of excess in the markets right now. And we probably knew that by the very nature of, the last 5 days or so, the NASDAQ 100 hitting an all-time high pretty much every single day, not taking a break. But this week we have, as I mentioned, a lot of things happening. The banks will be in the spotlight this week. We're going to see that earnings from the major players, from Wells Fargo to Goldman Sachs to Bank of America. So these are going to be very important. Now, it's going to be a tough quarter for banks. There's no question about that. This is not the environment. If this is the environment for certain companies like an Amazon, this is not the environment for companies in the banking sector. Between the interest rates being as low as possible, the yield curve being relatively, I would say, flat, and for a record number of potential bankruptcies and loans gone bad and people out of work, and all the things that are associated with banking, right? People not really able to spend and possibly loans not being created. Even though we saw some really good housing numbers recently, the fact remains it's not a good atmosphere or environment for banks. It just isn't. And that shows up pretty well in what we're seeing in the stock charts of all these different companies. So one thing, though, that you have to realize is if we know this, everybody else knows this. And this tough quarter and possible year is pretty much, I think, priced into the game already. You have a situation where there's really not going to be too many surprises. If banks come in worse than expected, I don't know if people are going to really flinch too much. The question is going to be, how are they feeling about the outward look, if they even gave us any kind of indication of that during their conference calls. But I would think that there is so much bad news that is already built in to the banking sector that it almost could be a relief rally that we've seen so many times before. Oftentimes we see that banks come out with numbers, they beat their estimates, people are really excited about that, they take the stocks up for a matter of days, and then they turn them down lower. But what we see in the past in these kind of circumstances is that so much is priced in. There's so much short activity on these names that a lot of times that unless things really get bad, much worse than anticipated, the reaction is probably going to be that there's going to be some relief. And I would expect that, again, unless something really goes very, very wrong here. So we have markets running blind right now. We have a situation where there's no real discounting of the idea that we're going to see rollbacks, that we're going to see closures, that we're going to see the states are coming out and saying, you know what, this is really bad. I mean, I don't know what's going to happen in Florida. Governor DeSantis, who seems to have his head right up his tuchus, doesn't seem to really understand what's happening, or maybe he does and doesn't care. What's happening is that, we are seeing that there are areas that we're seeing major spikes, not only here, but I'm just focusing on here for a second, and nothing is even being said about the potential for, hey, you know what, maybe we made a mistake and opened up a little too fast, but let's roll it back a little bit. I mean, just going over and over and over again, telling us that the death rates are lower, but yet again, we have to wait a little while till the hospitalizations flow through from all the new people that are being, I mean, we had 15,000 people in Florida just a couple of days ago with positive tests. Positivity rates were 20%. They dropped down to about 11.5%. That's good. A lot more testing going on. So that helps the positivity rates, but nonetheless, some really bad outbreaks, some things happening. So it's going to be kind of this weird situation where when we have this horrible news, but yet at the same time, Disney is reopening in Orlando, one of the hardest hit areas also. It's very strange, while Disney in Hong Kong is closing down. So it's still at a crossroads with the economy, and depends on, I think, the reopening situation. Markets seem to be saying, you know what, it doesn't matter. As a matter of fact, the markets, I would go so far as saying that the worse the news is, possibly the better it is for markets. That's what is being basically interpreted by what's happening. Because if you think about it, what the markets are saying is, hey, you know what? The worse this is, the more we have the potential for stimulus. And right now on the drawing board is another stimulus plan. We've been told about that. Congress is working up something, the potential for a extension of the benefits that are being paid for federal unemployment right now, you know, the $600 per week. So that is something that we have to look at, and whether or not there's going to be another $600 extension, maybe 500, maybe it's going to be a phased out, maybe it's going to be compared to what your current salary was and say 75% of that is going to be what will be paid to you. I don't know how they're going to come up with and what they're going to come up with, but right now the number looks like at least $1 trillion. And remember something, we are on the upward move towards an election, and elected officials who want to be reelected are going to say, you know what, we're going to put whatever we can into this. And now that the numbers are in the trillions already, what's another trillion on top of what we've done already? The Fed's balance sheet has moved up from $4 trillion in February up to $7 trillion over the last few months. We have a $3.2 trillion deal that was done, that was paid out between the PPP and the whole CARES Act. So this new HEROES Act, which they're utilizing, and that acronym for, it seems to be they're going to put some possible infrastructure spending in. It looks like there's going to be some money for the schools, the localities, states, hospitals, and a good chunk for employment. Plus, there's going to be another, I would say, block of money that's going to be put towards testing and for other companies for either a vaccine or some kind of treatment. So there's a lot of money that's going to flow out. And I got to tell you, I can't wait for a few years from now for somebody to do accounting on all this and see really where the money actually went to, because there is some leakage into the markets. Markets and people, I think, also have a bit of pandemic fatigue right now. I feel like I just can't stand staying inside anymore. I mean, I didn't go outside. Well, I went outside, but I didn't go outside the boundaries of my house all weekend. I mean, just, it's tough. After a while, the walls start closing in. You're looking what to do. And there's only so many times I can go to the refrigerator, stand in front of it, stare at it, and hopefully something magical is going to come out of there and just feed me because I'm hungry all the time when I'm home. So I think probably not much more different than what's going on in your neck of the woods. And even if you wanted to go out, what are you going to do? Where are you going to go? So the thing is, though, that a lot of what's happening right now is we have this very strange market condition. I talked about this on the Disciplined Investor podcast this week about the recovery, because one of the things we're seeing is probably a rolling W type of recovery. Traditionally, where we're going to see kind of a move up, a slowdown. We're already seeing some things slow down already, and then a bring down, and then possibly move back up, depending on how these reopenings are happening. But inside of there's something fascinating that's happening. Think about this. I want you to imagine this. A K recovery, the letter K, where we had the first line down sharply, right? That's the left side of the K, the vertical line up and down that when you draw a K, think about that. And then we had a move up. And then from the center line right there, everything kind of came back a little bit. Now we're seeing this bifurcation, this dislocation, where some companies are doing well. Take some of the technology companies, healthcare companies, look at some of the areas within the markets that have done really well. Look at the areas and states that have done well versus those that haven't. Look at the areas within the economy that are doing better, like services are coming back strong as we have the reopening. Manufacturing, both of those when combined are squarely in the growth category from where they were in contraction. I think that's going to change a little bit, but then you look at the other side, the other part of the K, from the middle of that line down. And we have your financials in there. We have a lot of retailers in there, restaurants in there, leisure, hospitality, airlines. I mean, you know the list, right? So it's within these rolling W's, we also have a K recovery. And it's kind of fascinating because that's not, I mean, I've been doing this 30 years or so. Never had the idea of a K recovery until just a few days ago. So kind of an interesting situation going on. Before we go any further and answer the questions, by the way, you can load those up right now. There's plenty of people here. There's about 3 or 4 questions posed. Usually when I get going, there's a few more, but I want to talk about something just briefly. As we are being all of us, pushed into the online world, where we have the idea that we're buying things, we're doing more transactions, we are no longer going places to get information. I mean, yeah, obviously this is nothing new, right? But as we are going more and more online, and as we are being forced to do things that we may never have done before, like just simply maybe ordering online food for delivery, as an example, or ordering, I don't know, whatever you're going to buy from various places, or just using your online instead of going to the bank for deposits, etc. I think it's really important to recognize right now that as we are all doing this, and something just to keep in mind, just a little something here, that as more and more of us are moving online or doing more online, because a lot of us are online already, obviously, we spend most of our days in front of a computer or a smartphone. Scammers are on the prowl knowing this. So things you may get in the mail from the IRS probably have to be scrutinized. Emails that you get that are looking for you to click here to reset a password because somehow it was corrupted or somebody signed in. We need to keep a sharp eye out for this kind of activity where there is some suspicion, and think about every single thing that you do, and especially when we're dealing with online financial transactions. Do not provide personal information to non-trusted sources. If somebody calls you and says, hey, I'm calling you from Wachovia Bank, well, that's closed now, but Wells Fargo Bank or Bank of America or wherever else you may bank, and they say, you know what, just to confirm, can I please have your social security number? No, 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 no. You're calling me. You should know what that is. Why don't you repeat to me what my social security number is? So be very careful about providing any personal information that is identifiable for you, and be proactive in guarding your identity right now, especially when we have all that's going on and things are a little bit different than they were when we were kind of, for the last however many years, online and offline. Now that we have so much more online, we got to make sure that we have strong passwords. You know, the password of my name and my birthday is probably not good. So use strong passwords, mix it up a little bit, change them regularly. Try to use two-factor authentication for our clients. For example, when we have certain accounts, there is the option to use two-factor authentication for certain accounts, whether it's at, and especially like Interactive Brokers, they require that two-factor authentication. If you don't know what that is, that could be something like a mobile app that when you log in online, the mobile app will be hit, it will have to do facial recognition, and then it will automatically log you into the site. Or it could be a series of numbers that's sent to a text message. Or it could be an email that you have to click to authenticate your login when you actually log in. So let's be really careful right now. Let's make a commitment to each other that we're going to be very aware. We're going to be very aware of what is going on, aware of our virtual surroundings, so that we can make sure that we don't get fooled and scammed, because now is a time that I really believe that these hackers and scammers and phishing is with the PH is very, very, very high right now. And no, if you got the email that somebody just magically gave you because you're a great person $4 million, probably it's not what it is, okay? So anyway, I wanted to just talk about that. So if you have any questions, obviously there's a lot of things online. I am not a security specialist. I just want you to be aware and just bring this to your attention, something that we've been thinking about a lot. All right, let's get to the questions and we'll wait for those to load up. But basically, you can ask in the Q&A panel anything you want on any topic, and we'll do our best to answer it. All right, first question comes from Jack. It says, I have a question about another SPAC stock, symbol LCA. I thought that LCA bought Golden Nugget Online Gaming, but I read some online articles that Golden Nugget, or GNOG, will be traded on the NASDAQ in third quarter 20. In general, is it more profitable by the SPAC of or its acquired business? So SPAC, which is Special Purpose Acquisition Companies, which is a great name, very fancy name for what we had in the old days called blind pools, where it was a publicly traded company doing absolutely nothing. And then what happened was that a lot of companies would do like a reverse merger or backdoor into, shoehorn, if you will, into that so they don't have to go through the whole IPO process. And what's happening today is there is a bit of a mania when it comes to these SPACs. Let me tell you, my opinion, for the most part, most of these SPACs are going to end in misery. A lot of these companies are doing their best to try to figure out a way to have investors bamboozled by doing this. I don't think, Jack, there is an answer to this. I don't think there is an answer to whether or not you're going to be better buying the SPAC or it's acquiring business. Most SPACs are, a lot of the ones that are out there right now are privately traded. This is a roll-up with Golden Nugget and what's his name, Tillman. This is a little bit different, and I don't know why they're doing the way they're doing this. So I really don't have too much of an answer for you. I'm sorry. I don't think there's any, you know, I think the only thing you do is SPACs, unless there's a really great business underneath it, and there's a couple of them, is trade these things with the hysteria that's out there right now. We have a question that says, if I buy Fannie Mae right now, will my shares be wiped out when it is out of conservatorship in the future? This is a decade-old question, it seems, right? I mean, we're all wondering this. What's going to happen when Fannie Mae and Freddie Mac finally come out of whatever's going on? Are they going to be pushed out and what shares are going to be whole and they're going to allow for the shares to keep trading? Or is this, I mean, they publicly trade. It's very bizarre. You know, how much of a haircut are they going to mandate by saving them, right? How much of a cut is the government going to want to take for saving Fannie Mae, Freddie Mac during the height of the financial crisis? And is it going to now be an elongated period till they actually come out? And what is it going to look like anyway, considering what's going on in the housing area? I just read some statistics that upwards of 30% of people in rentals and in housing are not or not paying their rent in May and June. Remember, we got a relief on mortgage payments for people, no questions asked, by the CARES Act. So all those mortgage payments that weren't made are going to be put onto the back end of the deal. And you got to wonder how much stress this is going to be putting on traditional mortgage companies. I don't, you know, this is really honestly an age-old question that nobody really knows. I think it's a very, it would seem to be a binary outcome here with regard to what's going to happen. And a lot of people are betting, and a lot of people that are really smart are saying, hey, you know what? This is going to be a great deal on the back end of this. Get the government out. We can go back to partying as normal, and they're buying shares in it. Other people saying, you know what? It really should be wiped out. So that's the way it's supposed to be going. Let's see. Steve asks, he says, Andrew, I have largely followed a lot of your advice, and as a result, I'm half in and half out of this market. So I have some cash. Is there a safe way to earn more income than banks are offering on savings and checking? My current bank cut the little interest rate I was getting in half. Thanks, Steve. You know, that's a problem right now, because what's happening is this same question you're asking is, okay, I got this money in the bank. What do I do with it? I'm not earning any money on it. And the Fed is doing that on purpose. In other words, because of the low rates the Fed has cut it down to, it's forcing savers out of the safety of a traditional bank account, which is, of course, covered by FDIC, and into something else. And there's the idea that TINA, T-I-N-A, there is no other alternative to, well, stocks. Because stocks right now in the S&P 500 have maybe, I don't know, 2.5%, 3% yield on them. And you look at that compared to treasuries, well, that's a good deal if there's upside opportunity. You look at them in comparison to a bank interest rate of 0.2, and that's really not a great deal. So there are some money markets out there that you can invest in. You're not going to make a lot of money on that either. I think that right now the choice is either I'm invested with the idea that in alternative assets, not in, I'm saying the money outside your bank, I'm invested and I'm going to, take that risk, and the money in the bank, in the safety play, is just, not making money right now. And that's okay. It's okay, because if you're looking to have safety, let's just say that there is no requirement or there is no mandate that you have to make money on your money if that money has been designated for my safe money. In other words, it's okay for a little while, as we have a lot of very strange things going on, to have your money in a safety play, not earning a lot, but also not losing. Now you may say, Andrew, but whoa, look at the markets going, what's happening? I mean, yeah, I can give you other assets to look at, but all of them are going to involve some form of risk. And that's not necessarily a bad thing, but if it's the money that you have tagged and set aside for the non-risk investment, well, that's what it is. That's what your bank is right now. That's what the money markets are right now. You could buy some treasuries maybe, you know, but you're not going to get much on those either. So there's really not a significant opportunity outside of what you're doing. But keep up the good work. I appreciate that. 1 foot in, 1 foot out. Perfect. So Steve has just a comment on PEP. Earnings are down 14% from the quarter. That's what I said. Yeah, they're down from last year, but the stock is trading in the same range as a year ago. Looks like the PEP PE is currently higher than a year ago. Yes, it is. It is not that much higher. It's not that much out of bounds. But yes, clearly, if the stock is trading at the same level, Pepsi, we're talking about PepsiCo here. Stock is trading at the same level as it traded a year ago, but yet earnings are lower. That would necessarily mean that the PE multiple is higher. PE multiples are a lot higher on many stocks right now. Some of them are in the stratosphere, to be honest with you. And the reason for that is that interest rates are so low. So theoretically, you can look at a discounted model of cash flows or a dividend discount model or any kind of model that you're going to put in a risk-free interest rate and look at that compared to the stock, and therefore stock can supposedly support a higher multiple. So yeah, I think that is correct. G6 asks, where's the chart? I don't know what that means. I'm not sure what that means. Where is the chart? I'm going to pass on that one. And ask your questions right now. We have 1, 2, 3, 3 or 4. Next question. Why is USO so dislocated? Oh, this is a great question. So why is USO so dislocated from the price of oil? I bought it when oil was in the low 20s and lower, but I am now down 20% on USO. Is there a better way to play oil if you see a good price? So a couple of different things. USO it's one of these ETFs that really should not be in business. I had some people I know, a very good friend of mine actually, when oil, if you remember when oil was down at like -20 and USO was just crashing, right? Well, they said, how can I buy oil? I said, well, you should buy the futures. Like, I don't want to buy the futures because if I buy the futures, which one I'm going to buy? Because I have to then go every few months and renew them. And I said, well, the problem is that role, the futures role, where you're going to be, let's make this really easy for a second. Let's say, just pretend for a moment that the futures on oil rolls every 2 months, meaning there's a contract that let's say is January, then March, then May, then July, then September, right? There's every 2 months there's a new contract, and that contract is meant for delivery at the end of the contract. So you can, assuming that you don't want to take delivery, you sell before and you buy the next contract or the one after that. But the active contract, the one that's right in front of us right now, is the one that is going to be significantly traded, more volume, and more appropriately priced to the actual price of oil. Okay. The problem is that USO historically has had to buy the front months, and then they'd buy them, and then if there was what's called contango or backwardization in the price of oil, they may lose money on selling this month and buying then 2 months later, right, when it rolls, selling the old one, buying the new one. So what's happening is that they had such a problem, especially because they were buying the front months, and they were going to get absolutely their clocks cleaned when oil was like at -40 towards the end of the month, and then they had to buy the next one at a plus, I think it was, let's say, trading at 10. They're going to sell the -40 and buy the plus 10. They just lost $50. So USO then came in and said, well, you know what? We're no longer going to be buying the first month. And they did something different where they're going to buy multiple months, multiple contracts over the future. And it just screwed up the whole deal more than it was before. USO is a really bad instrument. Many of the commodity traded ETFs that are those that roll and have a lot of roll, what would be the right word? A break in the price on the roll are just horrible. It's horrible. The only thing worse than that is a levered one that you hold on for a long period of time, which is naturally going to degrade. So I would think the best way to buy this is either one, it's a little bit off of what you're talking about, but possibly buy the oil and gas stocks. Buy stocks that are in maybe in refining or in exploration or in that general area of energy. You can look at those stocks as something that will have a levered effect to the price of oil. The second thing, and that'll be more of a pure play. The second thing you do is buy the futures. I mean, because doing this is just, you'll be knocking your head against the wall forever with this. G6 says, have you ever run across CRAVE, a new idea in the food prepared at home delivery? I don't think that's the same thing as this other thing, new idea in food preparation. I had something I saw recently where you would go, well, it was before all this, but you go to someone's house who is an aspiring chef, and you go and maybe 6 of you have a dinner at their house, and they would have a whole dinner plan. I haven't seen CRAVE yet. I'll take a look at it. Thank you. Appreciate that. Quan asks, hi, Andrew. I just recently learned about tick charts versus time-based charting. Can you give your inputs about watching tick versus time-based charts? I'm not a big fan of tick charts. I think that, you know, what happens with a tick chart is every tick, it gives you a new position. And who needs to be watching every single tick? I mean, it's kind of like watching a clock and every single tick to tell the time. Don't you want to tell the time every 15 or 20 minutes and look at it that way? Trying to tell the time by watching the ticks, tick, 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 like it's going to be, all right, 15 seconds, that was a lot, but what do you get? Not much. The information that I think is presented in a traditional based chart with using especially volume is a lot healthier of information than tick-based charts. And I know there's a lot of different ticks and they're all random. You can have 1,000 ticks. Well, that's good for one stock, but what about the stock that doesn't trade that often? What kind of information you're getting there, and why would somebody use that? I never really understood why people use tick charts. If you want to look at something really interesting, you could look at, there's a chart that is much different than the charts. It's called, now it's went right out of my mind. Point and figure. Check out point and figure. Do a little bit of research on point and figure. This is not time-based at all, and it's probably a better way to look at things than tick charts if you're trying to get away, for whatever reason, from time-based charts. But I think time-based charts still have a lot of utility in the markets. Question come in, is this mostly Fed trading? No, is this mostly Fed liquidity and layman people, lay people, sitting in their house trading? Large tick FANG stocks, especially Fed liquidity with ETFs forcing it. You can just state your opinion, that's all. Yeah, I think there's a lot of liquidity that's being provided by the Fed. Yes, I think there's a lot of people at home. You could see, one of the things you could see, I studied a lot of Bitcoin trading back in the day when it was trading, and then it has a certain footprint and feel to it. And some of the trading that we're seeing in the markets that we see with this very strong moves off of significant downstrokes on volume is very reminiscent of what I saw with Bitcoin and cryptocurrency trading. So there's a lot of that going on. I think basically people think, hey, you know what? It's down, so I'm going to buy it. They don't look at, you know, why it's down. It's up. Hey, you know what? It's going higher. That's very retail oriented, very novice oriented. And that's okay. You can make money doing that. Nothing, I'm not saying that in a bad way, but it has all the tracking points of what I remember when I saw Bitcoin trading. And yes, I think there is a lot of that. Now, on the other hand, I don't necessarily think that some of the moves that we have are necessarily able to be done by retail only. So I think there's a lot of other things that are involved here. Like you said, some Fed liquidity as well. A lot of anonymous questions. Bank stocks are up lately. Is it wise to short them prior to the earnings expectation? Yeah, the dividend cut is a big issue. I agree that could be something. You know, we're looking at possibly dividend cut by Wells Fargo. JP Morgan said dividend is secure, which always makes me nervous. Anytime they start talking about the dividend like that, saying, we'll never cut our dividend. You remember back in the day, you know, Lehman Brothers, we're not cutting the dividend. We are secure. We are financially stable. Okay. So just be careful with some of that. But I don't know if it's, I would wait till after they report. I just think the edge on your side will be let them report, let them come out with some good numbers. If in fact they cut the dividend, it could be a relief because they'll save some money. If they do some cuts and they do some expense cutting, it could be beneficial. But yes, longer term, there could be some issues with regard to them. I still think there is possibly a rotation coming up in the banking area once we get a little bit of relief from whatever they're going to tell us next week. Now here's just a general question. When drawing trend lines, do you connect high, low price values or do people use open, low? So yeah, trend lines can do either way. And this is all depends on how you want to trade. The question about, do I connect the highs and the lows or do I connect the open and close? I prefer using the open and close because that will give you a real better look at where the stock is trending on the close. Use close only. Keep on track, do the trend on the close, not on the open and the close, on the close. So I think it's a better way to do it. You can draw channels against the highs and lows. So you do multiple lines and you can draw them from, let's say it's a stock chart that is moving from bottom left to top right. So it's kind of sloping higher. So what you do is you connect all the tops across, see if there's a trend there, and all the bottoms, and see if that trend holds and see where that range is from there. But when drawing a trend line, I prefer to use multiple points. Don't try to force it. Use multiple points, at least 3 consecutive highs, or 3, not consecutive, but 3 highs along the place to do an uptrend, and 3 lows to do a downtrend. That is one idea. Last question. Why are the, let me click that, from Nicola. Nick, hey Nick, what's going on? Why are the options so much more volatile compared to stocks? Say 1% move in the SPY triggers a 10% move in the puts call 6 months from now. Yeah, I mean, there was some options I saw today of 30, 40, 50% actually on that. And that's the point. Options are levered and they all price in the expected forward move up into that point, especially ones that are out of the money. This is where you can get some real opportunity. So I think that when you have the desire to be in options, understand they are a levered play on the particular pricing move of the markets. Understand also something else, like today's situation. Today, the VIX spiked to above 30 plus again. So your pricing on the future move is volatility. That's one of the components that you price into options, as well as the time it takes until the option expires, as well as the price move and how far you are away from or at the strike price or the value comparison to where the option is and the stock, let's say. So all those things come into play, but when you have volatility spike, it naturally increases the price of the option itself. Last question, Andrew. Andrew asked this. Andrew's going to answer this. Different Andrews. Over the last few years, your credit cards, PayPal, Square have performed extremely well. Do you have any thoughts on the high valuation of these companies or if growth will slow down? So this is, again, one of the plays that, hey, you know what? Cash is going away, not necessarily being taken away, but going away, right? People do not want to, not everybody, but people don't want to necessarily, especially with the pandemic, be taken in and given out cash and coins and all that. So we're going to swipe, we're going to read, we're going to use mobile apps. And that's why these companies are doing well. Don't forget, a credit card company gets a piece of all the action. And if in fact we are spending more and going towards more technology related spending, when I say that, I don't mean spending on technology, but the way that we spend, the actual transaction is done through technology, that each of these companies gets a little piece of it. So those things are, cha-ching, cha-ching, just constantly getting a little piece of it. That's why Visa has been a great stock for over the years. MasterCard as well. Square is picking up. PayPal, to a lesser degree, but still very good. So the credit card is not going away. The opportunity to pay utilizing some form of, I would say, non-cash, a non-cash transaction is extremely high. I mean, people aren't writing checks. The young people don't even know how to write checks. If I put a checkbook in front of one of my kids, I really do believe this, and I said, you know what, write yourself a check for $10,000 right now, and if you do it correctly, you can keep that check, they couldn't do it. Not that I was bad at trying to train them to do that. There's no reason to do that. The days of how I used to write checks in my office, we used to write checks all the time. Hardly write a check anymore. I mean, honestly, 500 checks will probably last me 5 years. More than that, probably a lot more than that. All of my transactions are done either via credit card, automatic payment from my checking account. The only thing that happens every once in a while, a little salary here or there, but otherwise, most other payroll is done electronically. Some payments to vendors here and there, maybe a check, but relatively very few. So it seems to me that you want to stay on the lookout for some of these companies and for where this is all going. So, all right, we're going to end it right there. Thank you very much for joining me. We'll be around next Monday at 4:30 in the afternoon. Of course, 9 o'clock tomorrow night, live with John C. Dvorak. Myself will be talking about all the weird sides of business and finance. And of course, Fridays, if you're interested in technical analysis, we do a little discussion of technical analysis and a weekly recap related to the market specifically. You can sign up for that over on triggercharts.com. If you have any questions at all, you know where to reach me, info@horowitzco.com. Thanks for joining me, and I'll see you again next week.